Credit cards can help you build credit while offering convenience. When you need to make a purchase or pay a bill, credit cards can offer both convenience and the potential to save money if you're earning back some of what you spend in rewards. At the same time, you can also use credit cards to build credit history through healthy financial habits. While credit cards and debit cards may look similar, they work very differently. If you're new to using credit, there are a few important credit card facts to know. Credit cards have a credit limit you can make purchases against, then repay at a later date. Carrying a balance on a credit card can trigger interest charges. It's important to read the fine print closely on credit card promotional offers. Some credit cards allow you to earn rewards on purchases in the form of points, miles, or cash back. What is a credit card? A credit card is a physical card that can be used to make purchases, pay bills, or depending on the card, withdraw cash. The simplest way to think of a credit card is as a type of short-term loan. When you open a credit card account, your credit card company gives you a set credit limit. This is essentially an amount of money the credit card company allows you to use to make purchases or pay bills. Your available credit is reduced as you charge things to the card. You then pay back what you spent from your credit limit to the credit card company. Note: credit cards can be secured or unsecured. A secured credit card requires a cash deposit to open, which typically doubles as your credit limit. How credit cards work. When you're approved for a credit card, the bank authorizes a credit limit, the maximum amount you can borrow, to be used at your discretion. Your credit limit will depend on such factors as your income, your other debts, and how much available credit you have on other cards. There are payment networks. They are Visa, MasterCard, Discover, and American Express. They process credit card transactions. They make sure that the money for the purchase gets to the merchant and that the correct cardholder gets billed. Credit cards can be used to make purchases online or in stores and pay bills. When you use a credit card for either one, your card details are sent to the merchant's bank. The bank then gets authorization from the credit card network to process the transaction. Your card issuer then has to verify your information and either approve or decline the transaction. If the transaction is approved, the payment is made to the merchant and your card's available credit is reduced by the transaction amount. At the end of your billing cycle, your card issuer will send you a statement showing all the transactions for that month, your previous balance and new balance, your minimum payment due, and your due date. The grace period is the period of time between the date of a purchase on your card and the due date listed on your statement. During this period, if you pay your bill in full by the due date, no interest charges accrue. But if you carry a balance month to month, your card issuer can charge you interest. Your credit card's annual percentage rate, or APR, reflects the cost of carrying a balance on an annualized basis. Your APR includes both your interest rate and other costs, such as an annual fee if your card has one. Most credit cards have a variable APR that's tied to the prime rate. This means your card's APR can change over time, though the Card Act of 2009 sets strict guidelines on when credit card companies can and can't raise your rate. Warning: being 60 days late on making payments to your credit card can trigger a penalty APR, which can approach the 30% range. How to compare credit cards. If you're in the market for your first credit card or your next credit card, it's important to do some comparison shopping. Some of the key things to look for when comparing credit cards include: 1. Regular variable APR for purchases. 2. APR for balance transfers and cash advances. 3. Promotional APR terms and conditions. 4. Annual fees. 5. Rewards programs. 6. Introductory bonus offer terms. It's also helpful to look at the card's other benefits and features, if any. For example, if you're interested in opening a travel credit card to earn miles or points toward flights and hotel stays, you may also be interested in finding a card that comes with benefits, such as airport lounge access or airline fee credits. If a card has an annual fee, it's helpful to compare the value of rewards and benefits to the fee to decide if it's worth it. Types of credit cards. 1. Rewards credit card. Rewards credit cards give you something back for each purchase you make. Generally, these cards require good credit. They come in different types. 2. Cashback cards give you money back. You can usually get that money as a check or a deposit into a bank account, or you can use it to reduce your balance. 3. Airline credit cards and hotel credit cards give you miles or points that you can redeem for free flights or stays with the card's partner airline or hotel chain. How you redeem your rewards on these cards might be subject to restrictions, such as dates when you can't travel. 4. General travel cards give you points that you can use to pay for any travel expense. They're more flexible than branded airline or hotel cards. 5. Store credit cards reward you for loyalty by giving you discounts or other benefits for shopping at the store that provided the card. Rewards cards are ideal for cardholders who pay their bill in full every month. When you carry a balance, interest charges nip away at the value of rewards. Low interest. Low interest cards don't give you rewards. Instead, they provide value with a lower interest rate, making it less expensive to carry a balance. Many times, these cards will come with a 0% introductory APR period, giving you time to pay off a large purchase without interest. You usually need good credit to qualify. Balance transfer. A balance transfer credit card lets you move your debt from another issuer to take advantage of a lower interest rate. Generally, these cards require good or excellent credit. Cards for average or bad credit. Credit card options for those with less than good credit are more limited. Rewards are more scarce and interest rates are higher. Use these cards to improve your credit so you can qualify for better offers down the road. A good card for average credit won't charge an annual fee, or it might offer rewards with a fee. For bad credit, your best option is usually a secured credit card. These cards require a security deposit that you get back after closing the account or upgrading to a regular, unsecured card. In the long run, a secured card is less expensive than unsecured credit cards for bad credit, which tend to charge high fees that, unlike a security deposit, you never get back. Student cards. Being a college student doesn't automatically qualify someone for a student credit card. The Credit Card Act of 2009 prohibits issuers from giving cards to people under 21 unless they have proof of income or a cosigner, someone willing to put their credit on the line to help the applicant build theirs. When that's not an option, a secured credit card is a way to establish credit. Costs of carrying a credit card. Credit cards can come with costs, but you can avoid most of them with responsible use. They include 1. Interest payments. Credit cards can have different interest rates, or APRs, for purchases, cash advances, and balance transfers. When you pay in full every month, your purchases don't accrue interest. 2. Annual fees. Some cards charge annual fees, from around $20 to hundreds of dollars. An annual fee can be worth paying if the card gives you rewards and perks that make up for the cost, but in most cases, you shouldn't pay a fee just for the privilege of having the card in your wallet. 3. Late payment fees. The cost varies by issuer, but federal regulations limit how much late fees can be. As of 2018, first-time late fees were capped at $27, and fees for a second late payment within 6 months were limited to $38. Late fees also can't cost more than the minimum payment due. 4. Balance transfer fees. Generally, balance transfer credit cards charge 3% to 5% of the amount of debt transferred. Some cards waive the fee when you transfer debt within a certain time frame. 5. Foreign transaction fees. Most cards add a surcharge of 1% to 3% on transactions made with non-US merchants. Travel credit cards generally don't charge these fees, and some issuers don't charge them on any of their cards. The bottom line. Credit cards can be a credit-building tool if used responsibly. Paying your bill on time, maintaining a low balance, and only opening credit cards as needed can help you build and maintain good credit. Also, keep in mind that the best way to avoid interest charges is by paying your credit card bill in full each month. If this video was helpful, like, comment, and subscribe to this channel for more videos. Thank you.